Hello, internet friends. Daniel Foch here, real estate broker practicing in the Greater Toronto Area. One of the two hosts of the Canadian Real Estate Investor podcast, which is a top 5 business podcast in Apple Podcasts Canada, and a spin-off show for the Canadian Real Estate Investor, which is consistently a top 25 national podcast in Canada. I'm here today because I promised a lot of you that I would do regular market reports just to kind of fill in the gap that I saw of what was happening on YouTube. YouTube's obviously not one of my best platforms, and I apologize for the cadence of my posts. They're not exceptionally good. I obviously am not very good at post-production for long form. And I also think that most of you who are looking for content on here are being exceptionally well served by people other than myself. Now, with that being said, I haven't really seen a granular analysis of what's happening across different real estate markets in the country and also in the Greater Toronto Area. Again, on a more granular level, I think we're seeing it on a relatively specific level from quite a few different people. But without further ado, I'm going to do a walkthrough. My goal here is to do monthly market reports, 2 different monthly market reports. So the first one being around the first of the month, and it would be GTA data, so Toronto Real Estate Board data, which is available on the Habistat for paid members through, if you have a real estate license, you can pay for a membership and get back-end data, which is basically just aggregating charts of Toronto Real Estate Board's VOW data, VOW, which means virtual office website. This is available to realtors through a license. The other piece is what I'm going to is the public section, which is if you just go to the habistat.com/analytics-platform, you can actually follow along and use some of these tools here. So I am going to be using mostly this benchmark home prices tool here. It says better understand benchmark home prices using a number of pre-built analysis. If you click here, it'll bring up a Power BI, and basically you can click through. So the biggest ones that I use is how do various cities compare over time. Then also how much have prices changed since, and this will basically give you a list of where I'm going to do some off-peak calculations. So from when the rate hiking cycle started, where markets are standing. And then I'm also going to look at this tab here, which is which location saw prices change the most. So without further ado, let's get into that. So in which location saw the prices change the most, I have here the month over month, or MOM. Everything to the right of this line, this yellow line here, is markets in which prices have gone up. Everything to the left is markets in which prices have gone down. So that yellow line that you can see there is 0. So I think there was only 9 markets in Canada in which prices went up, and only 3 markets in which prices went up month over month more than 1%. So those not and I think it's also worth noting here that HPI, the house price index, is not a perfect measurement of what prices are actually doing, and I'll get to that a little bit more. But the easiest way to illustrate that is if you look at some of these markets here in the GTA. It says Greater Toronto was down 3.9% month over month. But if you look at the year over year, it'll tell you that Greater Toronto or certain areas in Greater Toronto are still up. And some of these areas aren't up, right? Like it's not showing us that any of these markets are down year over year, whereas they actually are. So again, HPI I would take with a grain of salt. I think it's a very lenient metric when you're trying to measure the velocity up or down of house prices. It's definitely smoothed out quite a bit. Returning to the month over month here, PEI, Newfoundland and Labrador, and St. John's, Newfoundland were the only markets that grew over 1%. The only market in Ontario that grew, so there was only 2 markets in Ontario that grew, Bancroft and Sault Ste. Marie. And then the remainder are outside of Ontario, and they're relatively more fringe markets. They're not markets that have been heavily exposed to this massive speculative activity in real estate. So we have Saskatoon, Fredericton, Greater Moncton, which actually Moncton on the year-over-year basis is one of the highest growth since the beginning of COVID. And I do think that when I look at a market like Moncton, Ontario shows us the correlation between prices going up, the velocity or the speed at which they went up, the rate at which they went up, and the rate at which they went down. So I think a lot of these markets, ones that ran up especially quickly, what happens there is you start to see a credit dependence happen, right? So the price goes up, people have to qualify for bigger mortgages to be able to afford those prices in that market. And so there's an embedded dependence on the credit market. And as those capital costs start to increase, as credit costs start to increase, then that market can contract a lot more responsively to interest rates than other markets. And I'm actually surprised we haven't seen this in Moncton yet. All of the other markets on this list, save for Prince Edward Island, I would say Prince Edward Island has some room to come down a little bit. Most of the other ones I would say are relatively safe. Bancroft, I mean, I make a joke out of Bancroft a lot. You're definitely seeing the seasonal cyclicality of Bancroft, and I'll show it on a chart here as well. But Bancroft dropped. I mean, it sold off probably 20% heading into the winter, and now because it's cottage season again, with Bancroft being a popular cottage area for the Ottawa market, and even for the GTA now, their prices are rising again. Bancroft is another area where I would see quite a good degree of vulnerability. Regina, I do think will be fine. I think there will be a degree of resilience there. I think if anything, their prices could actually go up due to exposure to commodities, to the oil market, to agriculture, potash, natural energy, etc., and just being an affordable and decent place to live. I'm not going to go through a lot of the markets that have remained relatively unchanged, although Sudbury, I mean, we are seeing some changes happening here. Sudbury's still ripping, honestly, like at least anecdotally, based on a lot of the agents I speak to up there. But some of the areas outside of that area, like, you know, your French River, kind of closer to Parry Sound, etc., that still would be in greater Sudbury on paper. And more rural areas of Sudbury are not doing as well. I think Sudbury has a degree of safety. I think that obviously there's a little bit of room for correction there, but I think that by comparison to some other areas in Ontario, Sudbury could fare pretty well, because I would say that as we start to diversify our economy, especially in Ontario, and we are seeing spending designed to do that, we're going to have to start pushing into things like nickel, things like lithium ion, commodity metals, etc. And Sudbury is a great place for that to take place. So I could see the job market really mattering as a bull case for Sudbury. Looking here at the places with the highest or the largest month-over-month declines, I don't think there's going to be any surprises here per se. I'm just going to go from the bottom of the list. So you have Huron-Perth minus 6.6%, North Bay minus 6.5%, Oakville-Milton minus 6.3%, Simcoe and District minus 5.8%, Hamilton-Burlington minus 5.5%, Kitchener-Waterloo, Brantford, Northumberland Hills, Lakelands, which is like just outside of Collingwood area, Quinte and District, so your Prince Edward County, Niagara region, Mississauga, Kawartha Lakes, Barrie and District, Greater Toronto area at minus 3.9%. Again, this is maybe a good little data point just for comparison of what HPI does by comparison to TREB data. So these are your month-over-month changes. If we go to year-over-year, again, it doesn't look so grim. You have Sault Ste. Marie as the highest growth market since this time last year. Greater Moncton being just behind it at 28.5% year-over-year growth. This is even after prices have been coming down for a couple of months. St. John, New Brunswick, Fredericton, Halifax, Dartmouth, Nova Scotia as an entire province. Then you start getting into Vancouver Island, Victoria, Sudbury, Windsor, Essex, etc., etc. PEI you can see here as well, and this is again why I do think there's a little bit of potential for a sell-off in PEI, but like if you compare these two Ontario markets, even just the build cost, you are relatively protected just by the price floor would be established by what it costs to replace some of these products. Or in appraisal you hear about this concept called replacement cost and new. North Bay being the last one I'll probably mention, and North Bay obviously being on that list of places that are going down in price fast right now as well. If we look at the kind of same thing pre-COVID, so if we were to go to February 2020 and to present day, You've got Bancroft being the highest, then Sault Ste. Marie, then your Tillsonburg. So you're still seeing a lot of Ontario markets show up here, North Bay, and then you're getting back to that Greater Moncton. And these are at a calculated compound annual growth rate of 29.5% all the way to 35.8%. And a change of Bancroft seeing over 100% change, so doubling of house prices since pre-COVID. And a lot of other markets seeing relatively the same thing. What I'm going to do is I'm going to start charting some of these now so you can just kind of visually start to see these prices rolling over in a lot of these markets. So these are your 5 major metros in Canada: Calgary, Greater Toronto, Greater Vancouver, Montreal, and Ottawa, all of which are now rolling over. You can see if you look to the right of this line, they've all sort of peaked in your February, March-ish. What I'll do is I'm going to show you Bancroft here just because I think it's a funny one. And let's just you can still see that Bancroft is still ripping here. So you see this dip, and if you follow Bancroft, like just for an example, right? If you follow Bancroft's price trend, you can see that it dips several times historically. This is just literally because it's a cottage market and it has a seasonal cycle. So you're seeing that seasonal cycle basically being supersized, especially from your January 2021 until August 2021. So this is your summer bull run in Bancroft, Ontario. And then you see a dip heading into Christmas time again. That's January 2022. And now we're ripping again into June 2022, although it does basically seem to have flatlined thereafter. Maybe I'm just going to make this bigger so that you can see a bit better here. So there's a couple of other areas that are worth looking at. Oakville, Milton being the highest peak and the highest sell-off so far, dropping from an average price of 1.6 to 1.2. Looking at some of these other Canadian markets, you can see like in Nova Scotia here, this orange line at the bottom, rolling over a little bit, but really only seeing like that looks to be about a 5 to 7% decline from peak. Again, a lot of these, like you can see here in Oakville, this massive spike, this massive run up that you see is almost exactly the velocity at which things are coming down. So as you start seeing a place like Nova Scotia where the price, it's a very much more graduated increase in price here, you would expect that you'll see a more graduated decrease in price as well. Some of these other markets, Peterborough and Kawarthas, which have been a pretty popular one, people talking about, felt a little bit resilient at the beginning and then started coming down. If you're looking at some other markets, PEI is still heading up. Some other markets, Quebec, Montreal, slowly starting to roll over, but again, not as steep of run-ups in their market, so I don't think there's as much encoded risk there. Saskatchewan, doing exceptionally well. They're still relatively stable, if not trending up. I honestly think this is really an inflation trade. These are two of the markets that are actually still up really well since March. And actually, I'll put Regina on here as well, though it basically just follows the rest of the province. So you have Saskatoon and Regina here, both still trending up. Winnipeg, I will put on here as well because it's started rolling over. It almost seems like anybody who's neighboring Ontario is impacted because if I were to put Montreal here as well, you can see the same thing happening. Let me get rid of Bancroft. So if you see Montreal here, it's rolling over. Some of the other extreme ones, you got Brantford with almost recovering to year-over-year decline, almost retracing all the way to a year-over-year decline already. And then markets like Calgary even starting to roll over. We saw a lot of GTA investors start rushing into Calgary. Edmonton rolling over a little bit. And then similar things happening in the British Columbia market to what's happening in the GTA. A lot of markets really rolling over on price here. Fredericton, if you're looking at Atlantic Canada, again, still trending upward and actually pretty strong since that rate hiking cycle started. Greater Moncton, same thing, but you are seeing a bit of a plateauing in the price on the Moncton side of things. Moncton's especially interesting to me because I've had this realtor on TikTok trolling me quite a bit for saying that house prices could come down, and I just thought that was kind of funny. So I'm going to do these are the TREB stats now. I apologize for blending these two market reports together, but I kind of have to in the interest of just getting this stuff out. I will hope to do 2 reports per month, so one GTA and then one in national level. CREA data comes out on the 15th. GTA data I can do at the beginning of the month. I can basically do it at any time. But I wanted to just look at a couple of different graphics here that matter to me on a GTA basis. And I think that talking about these in the context of what you could expect to see across the country is worth noting. So the major takeaways are we haven't really seen volume-led declines in the GTA real estate market yet. We're in a very slow market and absorption is slowing. So what I can show you here is the days on market. I think I got rid of this one. Give me a second. Days on market, historical trend. If you look at basically the bottom of the market, which is actually the lowest days on market I think we've ever seen potentially, was on average 8 days in February of 2022 in TREB. And at the median, 6 days on market is what properties were spending on TREB. Fast forward to present day, you've basically seen a really steady uptrend to 22 days on market on average and 15 days at the median on market. And this is important to me because you functionally doubled the amount of time that properties spend on the market, if not multiplied by almost 2.5%. 2.5 times. The reason that this matters is because as absorption slows, you start to get inventory piling up, right? And as you start to get inventory piling up, you can easily get to a months of inventory that is higher. And that's the metric that most people use to, your MOI is what most people use to say, oh, we're in a buyer's market or a seller's market, right? I think it's like between 3 to 6 months is a balanced market, greater than 6 months. These are US data points. I would say greater than 3 months in Canada, but let's say 3 to 6 months. And will we ever see a buyer's market based on greater than 6 months? I don't know, honestly. So what's happening as a response to this is people are getting fed up because they're like, oh, my house didn't sell in a week or 2 weeks like I thought, so I'm just going to take it off the market, right? And so you're starting to see this is where inventory is continuing to drop. Sales are continuing to drop because there's no good product out there, and now we're at a record low sales volume. I think we're trading at something like 50%, and we can look at this here as well, but you can see how some of these volumes are down. I'm just going to get rid of Toronto here. So some of these sales volumes in this far right column here, maybe I'll get this full screen as well here again. Just so it's a little bit more visible. So some of these sales volumes down, like Brock down 48% on the sales volume side. Vaughan down 37%. Georgina is down 39%. King is an interesting one because they saw I think Jordan did a video saying, people talking about house prices in King going down $500K. And you can even see here the delta on sale price to present day is, or from February to May 2022. If I go all the way to July, it looks like on the average these house prices came down by like 50%. But the reality is the data set is so weak, right? Like your volume is from 150 to 70 volume, right? And so the data point might not be exceptionally good. King can also have a lot of volatility just based on seasonality. When families are buying in a market like King in the spring, it skews the data up a lot because of composition mix. And I'm not trying to defend the market at all, but minus 40% seems extreme to me this early on, especially for a market like King. Where, again, it's going to function more like a luxury good, right? It should have a degree of resilience by comparison to a lot of these more commoditized markets. So again, looking at from basically February 2022 to July 2022, we saw some pretty big declines. So Brock is down 30%, Georgina is down 30%, Whitby is down 27.8%. Maybe I'll just take this from the top. So you have Ajax down 24.8%, Brock down 30%, Clarington down 27%, Oshawa 28%, Pickering minus 21%, Scugog minus 23%, Uxbridge minus 19%, Whitby minus 27%, Burlington minus 20%, Halton Hills minus 17%. I'm just going to actually switch here to also to look at the year over year, because I think that this is probably where it becomes a little bit more of an important comparison. So this is on the average. So you've got basically a handful of markets that are down year over year. And again, this is going to illustrate your king. You have 51 sales to like 20 sales year over year as your data points. So it's not exceptionally strong comparison, right? So you have Clarington, Oshawa, Uxbridge, Whitby, East Gwillimbury, Georgina, King, Markham, and Whitchurch Stouffville are all down on a year-over-year basis. You're seeing a lot of this happening basically in those more rural markets where people really flock to, maybe not rural, but suburban, those more suburban markets where people really flock to run out for COVID. And now with rising fuel costs and the reurbanization of the workplace and reurbanization of real estate demand, you're starting to see a lot of these people return to the city, and the demand is going with it. And so a lot of these places, basically, the further out you are, the less resilient you're going to be to the downturn that we're seeing in the GTA right now, I would say. Outside of the GTA, things seem to trade quite a bit differently. And so I can maybe analyze that next time I do an annual report. The last thing I want to look at here in Toronto or in the GTA market TREB data is the sale to list price ratio, because to me this is like super important. So we've seen the sale to list price ratio basically drop from almost 120%, so 118.8% on average, to basically a steady downtrend to below 100%. So on average now, properties are being bid below market value. Below list price. So this is an extreme expediting of downward price discovery. And I've said this a lot, but basically if you're underlisting properties, you make room for this to happen, because what happens is all that needs to happen is the bid needs to decrease rather than the asking price. The ask is already low. As long as the bid is decreasing, then as long as sellers are price taking, which in this market you'd honestly not be making a good decision to be price taking as we're in downward price discovery. And so prices come down. It's up to the buyers to basically set prices in a market where the bid-ask spread, the spread between the asking price is so low and the bid is basically establishing what the price of the market is, similar to the way a stock market works. So, on the way down, it's sort of whoever the buyer is gets to set that price, right? The only thing I would say that's worth noting here is that, with what August data we have so far, the average sale price in the GTA is actually up. We are in the lowest volume month that we've ever seen, I think. And so take it with a grain of salt. We are going to see some bounciness in the data. As you can see here, you do see prices kind of jump around a little bit cyclically. And then I think July was the bottom of last summer's cycle, and then August started to trend up into the fall market. You do start to see this phenomenon happen. With that being said, I think that it wouldn't surprise me if this fall market you do see a bit of a higher cycle. It's going to look like, I think it'll probably appear more like a bull trap. And people are going to, some people are going to be really trying to push that bull thesis that prices are extremely resilient and that you have nothing to be afraid of as an investor in the Canadian real estate space or a buyer in the Canadian real estate space, because prices managed to survive what was happening. I would be very careful when you're hearing this kind of thing, and I would be very careful looking at what happens in the fall market. That to me is really going to be, like, I think, again, we will see some cyclicality. You're going to see a bit of a consumption a composition bias in the summer. The type of product that trades is a lot different than the fall and the spring. Spring especially, you see an increase in price because families buy bigger homes, and so on. The average price and the median price both get skewed by that type of product commanding the market. So I just wanted to kind of go through all of these different data points to get an understanding for what's happening in the market right now. To me, the biggest thing to watch is how fast is inventory selling and how much inventory are we getting. And because at this point, I think interest rates have really already done most of the work that they're going to do. I think we do have one more rate hike coming in September, and I think it's obviously going to continue, but I think that most of the damage that interest rates are going to do has already happened. I think the next important part is, are there organic factors changing in the actual real estate market that are worth paying attention to? And, especially this means, from my perspective, is the amount of inventory getting bigger? So are we seeing higher months on inventory? Are we getting into a buyer's market? Because that will increase the downward price discovery that we're already seeing. And then is the amount of time, is the absorption slowing? Are buyers shopping around? Are we in a buyer's market, right? Are buyers taking less time or taking more time to purchase? There's a less sense of urgency, right? If you see the price setting, the position of price setting shift primarily to the buyers, I think right now we're kind of in between. That's sort of what a balanced market is. If you start to see that shift primarily to the buyers, you've really got a lot more potential downside from my perspective in where the market can continue to drop on a much longer, more drawn out basis by comparison to, your last cyclical downturns. So the 80s, the mid 90s, 89 to 94. These are events that took a long period of time, right? And if you look at the way that a lot of economists are analyzing what they feel is going to happen, it looks like, it's going to take some time. So I wouldn't expect the bottom to be in anytime soon. That would be, and I'm going to be watching all of this data to make sure. But it would basically be, from my perspective, you're going to see inventory pile up. You're going to see absorption start to slow. As soon as you start to see absorption kind of ramping up again in a meaningful way, I think that you could say, okay, yeah, the bottom's probably behind us. But I really don't see that happening for several years.